There is a legal document sitting inside your retirement account right now that most people completely forget about. And if you have not looked at it recently or ever, it could hand everything you spent decades building to exactly the wrong person. We are talking about accounts worth hundreds of thousands of dollars going to an ex-spouse, a deceased relative, or straight into a legal process that eats thousands of dollars in fees before your family sees a single cent. This is not a rare edge case. It happens constantly, and the financial industry is not rushing to warn you. Here is the thing most people do not realize. A will is not the final word on your retirement account. Your IRA, your 401k, your 403b, these accounts pass to whoever is named on the beneficiary designation form on file with the financial institution. Period. It does not matter what your will says. It does not matter what your attorney drafted. If the form says one name and your will says another, the form wins. Every time. That is not a loophole. That is the law. The beneficiary designation on a retirement account controls distribution at death. Your will governs your estate, the things that do not have a named beneficiary attached to them. The moment you designate a beneficiary on a retirement account, that account steps outside your estate and travels on its own track. The two documents can say completely different things, and the law will enforce both of them exactly as written. Let me give you a real-world scenario so this lands properly. A retired couple, married for 22 years, had everything organized. Updated will, powers of attorney, the works. What they did not know was that the husband's rollover IRA, the one holding the bulk of their retirement savings, still had his first wife listed as the primary beneficiary. He had set up that account in the early 90s, rolled it over twice since then, and assumed the paperwork followed him. It did not. When he passed, that account legally and cleanly went to a woman he had been divorced from for over 2 decades. His current wife had to watch that happen. There was no recourse. The form was valid. The ex-wife was legally entitled to every dollar in that account. And that kind of outcome is not exceptional. It is the predictable result of a system where the form controls the money and nobody tells you to check it. One of the most common ways this mistake happens is through a rollover. You leave a job, you roll your 401k into an IRA at a new custodian, and you assume your old beneficiary paperwork transfers with the money. It does not. When you open a new account at a new institution, you are starting fresh. If you do not complete a new beneficiary designation form at that new institution, the account may have no beneficiary on file at all, and when there is no named beneficiary, the account typically defaults to your estate. That means instead of passing directly to a spouse or child with no probate, the account gets pulled into estate administration. Probate fees, court costs, legal delays, thousands of dollars consumed before your family receives anything. A clean transfer becomes a complicated legal process, sometimes lasting months. This also happens when financial institutions lose or misplace old beneficiary records. It sounds like it should not happen, but it does. Institutions merge, systems change. Paper records from 20 years ago do not always survive a database migration. If your only copy of that beneficiary form is the one the institution holds, and that form disappears, you have a problem. Your family may spend months trying to prove what that form was supposed to say, with no guarantee they succeed. This is why keeping a personal copy of every beneficiary designation you have ever submitted matters more than most people think. Not a mental note, a physical or digital copy, stored somewhere your family can access it. Because the institution's records are not infallible, and the IRS is not going to help locate missing participants or beneficiaries. The IRS formally ended its retirement plan letter forwarding program on August 31st, 2012. That service no longer exists. If a plan administrator is trying to locate a missing beneficiary, they are on their own. The Department of Labor has guidance, Field Assistance Bulletin 2014-01, that describes minimum search steps for terminating defined contribution plans, including certified mail and free electronic search tools. But these are minimum steps. They are not guarantees. And the burden of a missing form almost always falls on the family trying to claim what they were supposed to receive. Now let us talk about what happens when the beneficiary designation is correct, but the heirs still do not know what the rules require them to do with the money they inherit. The Secure Act changed the inherited retirement account landscape dramatically for deaths occurring after December 31st, 2019. If you are counting on your adult children to inherit your IRA and simply stretch distributions over their lifetime the way beneficiaries used to, that strategy is largely gone. For most non-spouse beneficiaries, what the law calls designated beneficiaries, who are not eligible designated beneficiaries, the account must now be fully emptied by the end of the 10th year following the year of death. 10 years, not a lifetime. 10 years to pull every dollar out of that inherited account. And that deadline matters more than most families realize, because it does not just control timing, it controls taxes. When an adult child inherits a large IRA and is required to empty it within 10 years, every dollar that comes out is treated as ordinary income in the year it is withdrawn. If your son or daughter is still working during those 10 years, earning a salary, maybe at the peak of their career, those inherited distributions get stacked on top of their existing income. The combined total can push them into a significantly higher tax bracket. The money you saved over a lifetime, taxed at rates you never planned for, paid by the person you were trying to protect. This is not a hypothetical. The size of the inherited account directly determines the damage. An IRA worth $400,000, forced out over 10 years at uneven intervals, combined with a working heir's income, can generate a tax bill that consumes a substantial portion of the account. The exact number depends on the heir's bracket, but the direction is always the same. More income compressed into fewer years means more tax paid per dollar inherited. Now, there are exceptions to the 10-year rule. The law creates a category called eligible designated beneficiaries, and these individuals have more flexibility. An eligible designated beneficiary includes a surviving spouse, a minor child of the original account owner, not a grandchild, specifically a child, someone who is chronically ill, someone who is disabled, or an individual who is not more than 10 years younger than the original account owner. These individuals may still use life expectancy-based payouts in some cases, which spreads distributions over a longer period and reduces the annual tax hit. But here is where the minor child exception catches people off guard. A minor child of the account owner qualifies as an eligible designated beneficiary, but only until they reach the age of majority. Once that child turns 18 or 21 in some states, the 10-year clock starts. The longer payout does not last forever just because the child was young when the account owner died. The window closes and the 10-year rule kicks in from that point forward. That is a detail most families never hear from the institution holding the account. The custodian sends the money when asked. It does not sit down with your heirs and explain what the law requires them to do with it, or what the tax consequences look like if they time the withdrawals poorly. Let us shift to a mistake that is quieter than a wrong name on the form, but just as costly. Most people, when they do complete a beneficiary designation, name a primary beneficiary. That is, the person first in line. What many people skip entirely is the contingent beneficiary, the backup. And skipping that line creates a problem that only surfaces at the worst possible moment. Here is how it plays out. You name your spouse as the primary beneficiary. Your spouse passes before you do. Now there is no living primary beneficiary. If you have no contingent beneficiary on file, the account may default to your estate because the institution has no instructions about who comes next. The account you intended to pass cleanly to your children now goes through probate. The clean transfer you thought you had arranged does not exist. A contingent beneficiary is not optional planning for people with complicated estates. It is a basic safeguard. It is the answer to the question, if my first choice is not alive when I die, where does this go? Without an answer to that question on file with the institution applies its default rules, and those rules rarely match what you intended. And the problem compounds when a grandparent names a minor grandchild as either primary or contingent beneficiary without any supporting structure. A minor cannot legally own a retirement account. If a grandchild is named directly and there is no trust or custodial arrangement in place, the court gets involved to appoint a guardian of property to manage the funds. That appointment costs money, takes time, and the guardian, who may or may not be the person you would have chosen, manages the assets under court supervision until the child reaches adulthood. A trust, properly drafted and named as the beneficiary in a specific way, can solve this. The trust holds the inherited funds according to terms you set while you were alive. You decide how and when the money is distributed, who manages it, and under what conditions. For families holding retirement assets in the $100,000 to $800,000 range, this kind of planning preserves both the assets and your intentions. But the trust has to be drafted correctly and named correctly on the beneficiary form. A general reference to my estate or an improperly structured trust designation creates its own set of complications. The IRS treats a trust named as a beneficiary under specific rules. If the trust meets certain requirements, it must be valid under state law, irrevocable, or becoming irrevocable at death. The beneficiaries must be identifiable, and documentation must be provided to the plan administrator. The IRS may look through the trust to the underlying individual beneficiaries for purposes of determining distribution rules. If the trust does not meet those requirements, the account may be treated as if the owner died without an individual beneficiary, which changes the distribution timeline entirely. That is a significant distinction. A non-individual beneficiary, including an improperly structured trust or a charity, generally follows rules that do not allow the 10-year stretch at all if the account owner died before their required beginning date, the date by which required minimum distributions must have started. In that case, the 5-year rule may apply, meaning the account must be fully emptied by the end of the 5th calendar year after the year of death. 5 years, not 10. And for the year of death itself, this is one the family almost always misses. If the account owner had already started required minimum distributions and had not yet taken the full distribution for the year they died, that remaining distribution for the year of death is still owed. The estate or the beneficiary must take that distribution. Missing it does not make it disappear. It creates a compliance issue that adds cost and complexity to an already difficult period. The beneficiary form is not a document you fill out once and forget. It is a living part of your financial plan that needs to be revisited every time the circumstances of your life change in a meaningful way. Marriage changes the picture. Divorce changes it even more. The scenario I described earlier, the man whose ex-wife remained the beneficiary on his IRA for over 2 decades, is not an outlier. It is what happens when a major life event occurs and the beneficiary form is never updated. Some states have laws that attempt to revoke a former spouse's beneficiary status automatically after divorce. But these laws do not apply uniformly, they do not apply to all account types, and they have been challenged and overridden by federal law in cases involving employer-sponsored plans governed by ERISA. You cannot rely on a state law to do the work that a 5-minute form update would do. The birth of a grandchild is a trigger. The death of a named beneficiary is a trigger. Adopting a child is a trigger. A significant change in your financial situation, a large rollover, a new account at a different institution is a trigger. Each of these events should prompt you to pull the beneficiary designation forms for every account you hold and verify that the names on those forms still reflect your intentions today. And when you do that review, do not stop at who is named. Look at the structure. Is there a contingent beneficiary? Is the contingent beneficiary still living? If you named a trust, is that trust still in effect and properly maintained? If you named a minor directly, is there a plan in place for how those assets will be managed? The institutions holding your money will not remind you. Some will send annual statements. None of them will call you after your divorce to ask whether you want to update the form. That responsibility belongs entirely to you. And the cost of not doing it is not abstract. It is a 6-figure retirement account going to someone who should not have it, or disappearing into an estate administration process that nobody planned for and nobody can quickly fix. Here is where the control comes back to you. Every problem described in this video, the ex-spouse who inherits by default, the account swallowed by probate, the heirs blindsided by a 10-year tax clock, every single one of them is preventable with one specific action. Pull every beneficiary designation form on file for every retirement account you own, review it, and update it where it needs updating. Not someday, now. Contact each institution directly and request a copy of the beneficiary designation currently on file. Do not assume you know what it says. Get the actual document. Compare it against your current intentions, your current family structure, and your current estate plan. Then keep a personal copy of whatever you submit. Stored somewhere your family can find it, a fireproof document safe, a secure digital folder, whatever system you will actually use. Because the institution's records are not your backup plan. If you have experienced any major life event in the last several years, a marriage, a divorce, a death in the family, a new grandchild, a rollover to a new custodian, treat that as a signal that the form may no longer reflect what you actually want. Then fix it. The form takes minutes to complete. The legal mess it prevents can take months and thousands of dollars to untangle after you are gone. If you found this video useful, there is more where it came from. This channel covers retirement finance, Social Security, Medicare, taxes, and estate planning every single day, built specifically for Americans who want to know what the system is actually doing with their money. Subscribe so you do not miss what comes next, and share this one with anyone who has a retirement account and has never once looked at that beneficiary form.